Hey guys, welcome to the channel. Welcome back to another video. Welcome back to another live. We're going to have this quick conversation today about the Fed, the Federal Reserve, and the fact that they just stopped rate hikes just yesterday. The Fed is talking about perhaps some interest rate cuts coming up. We want to have a conversation about it. We want to figure out what this means for us as Americans or taxpayers or people that may be all around the country, but all around the world, but may have some interest in what's going on with the American dollar, American economy, and inflation, and the potential for a pivot ahead and what this means for us, guys. Periodically on this channel, I try to hit all things money. So if we may talk about personal money or personal finances, money management. We may talk about all different types in terms of money, all different types of things in terms of money. And sometimes I want to talk about what's happening with the U.S. economy because there's a trickle-down effect that happens for us and our money, right, with the economy. So welcome, guys. We're going to have this conversation. We're going to have it live. And oftentimes we have folks in here from all over the world. So check in and let me know what city, country, state that you're in, part of the world that you're in. And if you can hear me, give me a thumbs up and let me know that you can hear me real quick in the live chat if you can do that, guys. But we want to have this conversation today because of what just took place yesterday. Yesterday, the Fed met, and well, they met for 2 days. They always meet for a couple of days. And there was a press conference afterwards with the chair, who is the chair of the New York Federal Reserve. There's 12 districts in the Federal Reserve, and the head of the New York Fed is always the chair. And right now it's Jerome Powell. He came out and gave a press conference after the Fed had its 2-day meeting, what they call the FOMC, right? Open Market Committee, who decides on what they do with interest rates. And so that's why this is timely, and I like to bring timely things to you guys that are of importance for our money. Thanks for the thumbs up. It looks like you guys can hear me. Kenny checking in from Chicago. Good to have you, Kenny. Corey, how you doing, Corey? Good to see you. Good to see you here in the chat as usual. Raleigh, North Carolina. All right. I like that state of North Carolina. Good state. Sanford, Florida is checking in. Looks like we got some Denver, Colorado, where the famous Denver airport resides, right? And all of its secrets that people think are there at the Denver airport. We got Atlanta, Hucklebuck. How you doing, Hucklebuck? Checking in from ATL. Of course, we got the largest, I think that's the largest international airport in the country, in Atlanta. A lot of international flights leave out of Atlanta. But in the description box below, guys, let me alert you, heads up, there's some free stuff down there, 24 Laws of Money and some other things that you can check out, my website, etc. Guys, on Saturday, let me bring this to you guys up front before we get jumping on this video. On Saturday, we are celebrating with free giveaways. I'll be giving away a total of $500 worth of Amazon gift cards on Saturday, this upcoming Saturday, 11 o'clock a.m. to celebrate. What we're celebrating is this channel reaching 100,000 subscribers. So we want to celebrate that. My way of celebrating that, hey, it's right before Christmas, is to give away a bunch of money, Amazon gift cards. And so we just crossed over the 100,000 mark. So we're going to celebrate on Saturday. And so be looking forward to that. If you're here now, show up on Saturday at 11 o'clock a.m. Central Standard Time and win yourself $20 from Amazon. I think I'm going to give away at least a couple of $50 giveaways from Amazon, free gift cards, right? So check that out, guys. Come and hang out, and also be talking about on that live on Saturday morning, talking about how to start your own YouTube channel, because YouTube is an excellent side hustle. And I want you guys to know all of the different types of ways that you can earn additional income. YouTube is one of them. So we'll have that conversation and we'll do a free giveaway. So look forward to that on Saturday. So let's see here. We got Philly in the house. Scarface, good to have you here. Scarface Gamble. Wisconsin is up here. Good to have you, Wisconsin. Thanks so much, Corey. I appreciate that. It's been a whirlwind, man. I got so much information about how to do this YouTube thing that I'm just busting at the seams, ready to give you guys some good insights in case you're curious or you may want to start your own YouTube channel. We got Jacksonville, Florida here as well, guys. Smash that like button. Share the link to this video. We're going to have a U.S. economy conversation, right? Guys, let's talk about what's going on in the U.S. economy and how it's going to affect all of us, right? The Fed stopped rate hikes. They haven't raised rates in the last 3 times, I believe, that they've met, which was a big flip from before, right? They had 11 straight rate hikes, and all of a sudden now they're leaving it pat, leaving it right where it's at, right? And it's sort of feeling like inflation is winning. Inflation is coming out on top because the Fed kept saying for a year and a half, we want to get inflation down to 2%, 2%, 2%. Inflation is not quite 2% just yet, right? But they've stopped raising rates. And so it seems like maybe inflation won out on this one. The Federal Open Market Committee, that's the committee that decides on whether or not they're going to raise rates, lower rates, or keep rates the same. When I say rates, we're talking about the federal funds rate, right? Excuse me. Remember, at the beginning of 2022, guys, the Fed funds rate was all the way down around 0%. The Fed funds rate was all the way down. That's why you had mortgage rates in the 2.5 to 3.5% range, right? Really super duper low. Money was cheap, right? Money was cheap, and things were starting. Well, man, everybody's going out and getting these cheap rates, these cheap loans, right? And so we were just sort of started raising our head up out of the pandemic around that time as well. Between 2022, the beginning of 2022, and up until the middle to end of 2023, the Fed had raised the rates 11 straight times, the federal funds rate, to where it is right now. It's between, and it's always a range. The federal funds rate is always a range between 5.25% and 5.5%. Okay, so when I say federal funds rate, that's the rate. Just to be clear, so everybody understands this, right? That's the Fed raises and lowers this interest rate, but it's the rate that banks charge each other for commercial banks, overnight lending, right? After 8 p.m. and before 6 a.m., the banks are lending money to one another, right? And for this overnight lending, they charge each other a rate, an interest rate. And the interest rate is what we call the Fed funds rate, right? So the Fed funds rate. And who sets the Fed funds rate is the Federal Open Market Committee, the same ones that meet to figure out if they're going to raise that Fed funds rate or if they're going to lower that Fed funds rate. And I think they meet about, I think it's 8 times a year, 7 or 8 times a year. Every 6 or 7 weeks, they get together and have that meeting and say, what are we going to do with this rate, right? When the rate goes up, the Fed funds rate increases. The Federal Reserve or the Federal Open Market Committee says we're going to raise that rate. When that rate goes up, then all of the short-term interest loans that the banks charge us goes up also. Okay? So the banks who are lending money to each other every single night, right? Then they're charging an interest rate. One bank charges an interest rate for the other bank. Well, those banks, they have to offset their costs somehow. And they do that by upping, when it goes up, they raise our rates that we have to borrow money against, have to pay. So money becomes more expensive to borrow when the Fed decides to raise the Fed funds rate, right? So we're customers, they pass that stuff on to us, and me and you get hit with higher interest rates for short-term loans, right? So as the Fed funds rate has gone to from near 0% to 5.25% to 5.5% where it's at right now, so has the interest rates on things like car loans, right? Short-term loans, right? 3 to 5 or 6 years, sometimes 7 years for car loans. That's a short-term loan. Credit cards are considered short-term loans, right? And so credit card interest rates are in the 20-something%, right? All the short-term loans that we get from banks rate go up, right? They charge us more for it, right? And also, and now I say mortgage rates, but let's understand this about mortgage rates. Mortgage rates are not directly tied to the Fed funds rate, right? Mortgage rates are typically tied to the 10-year yield or the 10-year treasury bond, right? But there's sort of an indirect effect on mortgage rates. Think about it. Beginning of 2022, mortgage rates were what, 2.5%, 3.5%. Now mortgage rates are in the sevens, right? 7%. So it has sort of an indirect effect on mortgage rates, which are considered long-term interest rates as well. Now, I do understand that mortgage rates have gone down, right? I think we went below 7% in the last couple of days for mortgage rates, right? For 30-year fixed. But this is why all of this matters to us. Sometimes we see Jerome Powell doing his press conference, and we flick the channel and go right to Netflix, right? We don't care. But really, that's a big piece, because some of the things that we get loans for typically, like our credit card, or because credit cards are a loan, right? Or your auto loan, or even buying a house. All these things are affected by what this committee of 12, I believe, 13 or 12, this committee of 12 or 13 people, what they decide is huge. It affects all of us, right? The Fed funds rate, or interest rate, is simply the cost of money, guys. The cost of borrowing money affects all of us, because most of us, not all of us, but a lot of us, borrow money, right? For things, especially big ticket items, right? And when I say big ticket items, I don't mean just houses and cars. I mean big ticket items you put on your credit card, right? You might put something big on your credit card. Could be anything. A lot of people pay their bills with their credit card. So why did the Fed Fund raise interest rates in the first place, guys? Obviously to slow down spending, right? To slow down spending. Really huge, right? The Fed wants to discourage us from borrowing money. That's why they make it so much more expensive to borrow money, and they raise rates, right? Because when rates go up and the cost of money goes up to borrow, then typically a lot of people stop borrowing so much money, right? So they're kind of trying to control our spending and play a balance act with us, right? When people stop spending money and borrowing so much money, then the demand for goods and services goes down. That's how this whole thing is tied together, because when the Fed raises the rates and money costs more to borrow, the demand for goods and services typically goes down a little bit, right? And when the demand for goods and services goes down just a little bit, what happens when the demand for goods and services go down just a little bit, right? When people stop spending so much and the demand for goods and services go down just a little bit, then the theory is that prices will stop increasing at the rate that they were increasing. And that's all inflation is. Inflation is not the price of goods and services. Inflation is the rate at which those prices are increasing, right? That's what inflation is. So when inflation, you see prices going up with inflation, but prices are really just the rate at which, that's how we measure inflation, the rate at which prices are going up, right? That's the whole reason the Fed raises interest rates, is to deter us from spending money, slow down demand, and slow down the rate at which prices are increasing, otherwise known as inflation. And typically when this happens, guys, demand slows down and they can't raise prices as much as fast. So inflation slows down. Then typically what happens, guys, is unemployment increases. I say typically because it really didn't happen this time. Typically, unemployment is going to increase, because if I'm a business and money costs a whole lot more to borrow for my business, and now there's not enough demand out there for my product or my good or my service, I have to either not raise my prices as much, but I also have to figure out a way to cut cost. And what's the biggest cost of any business out there is labor. So when all this happens, this whole trickle down thing is happening from the top. Money costs more to borrow. Less people are borrowing money. Demand goes down for my product or my service. Now I have to go ahead and cut cost. The first place I'm going to cut cost is labor. I'm going to be laying people off. Can't afford you anymore. There's no demand out there. Now that's what typically happens. Now somehow, with what's been going on the last year and a half, it hasn't really worked out that way. It's done it slowly, but the economy is staying fairly strong. The job market is staying fairly strong, even though this is what happened over the last 40, 50 years when you study economics. This is what happens when interest rates are raised. But it didn't happen as much this time. The unemployment, the latest unemployment percentages is still super duper low. 3.7% unemployment is what the reading is, right? And it's remained at 3.4 to 3.9. Right in the threes is what the unemployment has remained over the last year and a half as the Federal Reserve has raised interest rates, which is odd, right? Which is very odd. Guys, do me a favor. Don't forget to smash the like button. We're having a conversation about the fact that the Fed just stopped raising interest rates over the last 2 or 3 meetings, but they just had a meeting a couple of days ago, right? And it feels like inflation may be winning out a little bit, although inflation has gone down. Again, smash the like button, share the video. Please, if you're not a subscriber, please consider subscribing to my channel. And please tune in this Saturday for a free giveaway. I want to make sure I mention that. Free giveaway, a total of $500 of Amazon gift cards. I'm going to give away it during the live. And as we do a couple of things, one, we're going to celebrate reaching 100,000 subscribers on this channel, which is, man, it's fantastic. I'm going to share with you guys a lot on Saturday on what I did, what I've been doing, how I've done it, etc. You know, how I've kind of worked with the algorithm, understood the algorithm, and give you some things to maybe consider starting your own YouTube channel, right? Because that would be an excellent source of income for you. And that's all this channel is about: making money, investing money, increasing our income, managing money, saving money. All those things is what we talk about here. So YouTube, we're going to talk about that on Saturday, and we're also going to be giving away a bunch of free stuff, guys. And by the way, today's video is I partner with Mint Mobile. Doesn't take much to switch over. I switched over to Mint Mobile. Great experience. Okay. Unlimited data, no drop calls. They use the largest 5G network in the world. They don't have salespeople in stores, so they have less overhead. So that means we pay less expensive price for the same good service. So it's solid, reliable. There's going to be a link to that in the description box as low. But I use it, so that's why I promote it and I tell you guys about it. So let's get back to the video. The major question here about the Fed's stopping the interest rates, the interest rate hikes is, has what the Fed been doing this whole time on trying to raise rates to slow down spending, is it working? Has it worked? Has it really brought down inflation the way they've wanted to bring down inflation? And we just got the inflation reports a few days ago. And that was a measure of where we are with inflation right now. Now, the inflation report said this. And again, inflation, just so we're clear, inflation is not necessarily prices, guys. Inflation is the rate at which prices are rising. Okay? And I'll get to that later. The CPI, which we call the headline inflation rose, and we call it headline because that's what you read in the headlines. When you read about inflation, the inflation rate is 10%. You're reading the headline inflation. So they call it the headline inflation. There's 2 different types of inflation readings, right? CPI and core. The CPI headline inflation rose 3.1% in November last month from 12 months earlier. That means the average prices of goods and services over this big basket of goods that they measure was up 3.1%. That's called year over year, 3.1% from November of last year, right? Year over year, 3.1% increase in the prices. That's the CPI, Consumer Price Index, right? Now, that's according to who reports it, which is the U.S. Bureau of Labor, U.S. Bureau of Labor Statistics is who reports that, right? And so the 3.1% year over year increase, obviously, guys, that's much lower than, let's say, June of 2022. June of 2022, guys, the year over year inflation was 9.1%. right? So if we measure that over the last 16, 18 months or so, CPI, headline inflation, is down, right? Way down from 9.1% to 3.1% year over year, right? That's huge. That means that what the Federal Reserve has been trying to do is actually working, right? That's a good thing. By the way, that 9.1% that the CPI was reading in the summer of 2022, that was the highest CPI inflation rate year over year since 1981, I believe, right? That's like 45, almost 44, 45 years, 43 years, right? So inflation was huge. The rate at which prices were increasing on goods and services was huge. It's much lower now at 3.1%. So yes, inflation is going down. Now, it may not feel like that because, again, it's not the prices coming down, so to speak, right? We see the price of something and we say, wow, prices ain't going down, because prices may not go down, but the rate at which those prices are increasing has slowed tremendously. And that's what inflation is. So inflation is down, right? So people always get confused about that, and they think that they're supposed to see the price of bread go from $3 a loaf to $2 a loaf. No, that's just the price is going to be what it is. But the rate at which that price is increasing has slowed tremendously. Now, I said there's two different types of inflation. There's CPI headline, but there's also the core PCE inflation, right? Which the core PCE inflation rate is the one that the Fed looks more closely at. That's the one that the Fed says we're going to focus and zero in on, is that core PCE inflation rate. Now, why? Because the CPI keeps in it food and energy. Food and energy. And sometimes food and energy, they're so volatile that they sometimes swing the CPI rating up or down based on just those two things, right? Energy, like when you look at, okay, so a big piece of why the CPI inflation is down now is because of energy, gas, oil, right? And so those things have sort of brought the CPI down a little bit. Now, the core PCE removes food and energy. And by the way, food and energy are tied together because it takes energy to produce food. It takes energy to transport food. It takes energy to get the food from the farm to the manufacturer to your table, or to get fuel in the plane to export that food from wherever it's coming from, right? Mexico, Brazil, Peru, wherever your food's coming from. It takes energy to get it over here. So energy and food are tied together. Matter of fact, it takes energy to run the machines that extract the fruits from the ground. Energy that it takes to run the manufacturing building that processes and produces and packages the fruit or the food. So energy and food are tied together and they're really volatile. And so what core PCE does is it extracts those two things. Energy and food, take them out, right? So are the outliers. And core PCE also looks at a broader group of things than just the CPI headline inflation. So the Fed focuses more on the core PCE instead of CPI, right? And the core PCE latest inflation rating was right about 4%. 4%, right? Year over year. That's a 4% rise in prices year over year, which is still down, right? Core PCE back in June of 2022, I think was in the 7%, a little over 7%. So it's gone down also, right? But the Fed wants to see their core PCE be down at 2%, right? So it's down. It's down at 4%, 4.1, 4%. Last year, core PCE was at almost 6%. So it's coming down too. Slowly going down from both the CPI headline inflation and core PCE. That's good news for us as consumers, right? Now, what I try to do on this channel, guys, is I try to say things in plain language that's easy to understand, right? So we're not just getting this quick blurb from the Channel 5 News that's going through stuff and you're not really understanding what the heck they're talking about, right? Because a lot of this stuff can be broken down They don't have the time for it, but that's why I like to do these live streams so we can really dig into it a little bit. So where are we now, right? As I said, the FOMC, Federal Open Market Committee, they meet about 6 or 7 times, every 6 or 7 weeks, right? Roughly 7 or 8 times a year. And they're the ones that decide what we're going to do with the Fed funds rate to raise it or lower it. Well, again, they left it alone this week. Didn't raise it, didn't lower it, right? So the Fed basically also signaled that coming up in 2024, right, there could be a possible lowering of interest rates, as opposed to what they've been doing is raising interest rates to deter spending and making money more costly. They may bring money down just a little bit and make money a little less expensive to borrow in the next year coming up, 2024, right? So the Fed raises rates, makes money more expensive, right? Stop you from borrowing money because you don't want to borrow money when it's more expensive, right? And then they lower the rates, right? To lower the cost of money, to incentivize you to, or sort of boost the economy to get you out there spending money and borrowing new money, right? This is how the Fed sort of manipulates and manages and pulls the strings of what the economy is doing. This Federal Reserve, I challenge you to read about how the Federal Reserve was started, what they were started for back in 1913, and you'll be surprised. I don't want to go through all that here on this video, but there's a balancing act that the Fed has to play, right? They control, manage, and manipulate the supply of money in the economy. It's the push and the pull. They've been pulling you back from spending, and now possibly in 2024, they might push you out there to go spend more to sort of stimulate the economy, so to speak, right? They sort of control our behaviors and patterns of behavior around money, right? And so, again, guys, make sure you smash the like button. Very important, guys. And we're going to talk about real brief what these rate cuts or not rate cuts is doing to us as investors, right? Because most of us in this chat are investors, or we have some money, or we're thinking about investing. So we'll talk about that as well. Let's see here. Wisconsin in the house. I'm just reading back through some of the chat. Hey, Seattle, Miss V, good to have you. Hopefully you'll be here on Saturday with us. No, I haven't lost weight. Man, I look like I lost weight. That's a good thing. I did do this yesterday. I played full court basketball yesterday for the first time. Got a bad knee. But I was out there with some young guns too. 20-year-old, 19, 21, man. And I wasn't that tired. I must be in pretty good condition because I was out there with the young guys, man. Basketball is a young sport, trust me. LA in the house, good to have you. Hey, congrats. Thanks, Pito. I appreciate you checking in from Minneapolis. Thanks so much. Frankfurt, Germany in the house. Good to have you away from Germany. Thanks so much, Kim. Appreciate it. So let's see here, guys. Let's kind of talk about, hey, Mommy Trader, good to have you guys. Check out her channel. Don't forget Mommy Trader. She's in the chat. She's got a YouTube channel that's growing as well, and she talks about investing quite a bit. So please support her as well. So let's talk about kind of the soft landing. You guys have heard the term kind of soft landing in the news, right? They always talk about we want a soft landing. The Fed says they want to achieve a soft landing and here's what a soft landing is, right? A soft landing for the U.S. economy is just basically where inflation is sort of tamed down a little bit. It's not out of control like it had been. Inflation is sort of under control, but at the same time, we avoid a recession. And when we say avoid a recession, we're just saying we avoid having a down GDP, right? The textbook version of a recession is 2 straight quarters of a down GDP. Gross domestic product. That's when the economy is said to not be growing. And we want the powers that be that run this machine called American U.S. economy, they want the economy to continually grow. You guys see my visual there? Continually grow. Kind of funny, right? Continually grow. They want it. And when it doesn't grow and it sort of retracts or doesn't grow, or it's down for 2 straight quarters, that's considered a recession from a textbook standpoint, right? And so the GDP has been tremendous. And so the funny thing about this whole thing is this, guys. Unemployment is still very, very low. The economy is incredibly strong, feels incredibly strong, right? Although people don't feel it because prices are still high and people still feel like they're living paycheck to paycheck. But all of this has happened while the Fed kept raising rates. Now, why the Fed doesn't keep raising rates is because they fear that they might raise them so high that they cause this recession. And to avoid that, they want to have what they call a soft landing, right? Where they control inflation, but they avoid the recession, right? What does this all mean for us from an investor standpoint? Let's talk about investing money. Many of us in here are investors, and so we're concerned about what's going on with the stock market or how the stock market actually reacted to what's going on with the U.S. economy and the Fed deciding not to raise rates again. So how did the stock market react over the last couple of days to the Fed's decision not to touch the rates for a third straight time in a row? The U.S. markets responded favorably if you're an investor. Depend on how you look at being an investor. The U.S. markets went high. They went up, right? Yesterday afternoon, following the Fed's meeting where the Fed Chair Jerome Powell came out and gave his press conference, the Dow Jones went up. Let me look at the dates, the amounts real quick. The Dow Jones went up 1.4%, closed really high. I think a record high yesterday, the Dow Jones. The S&P was up, right? S&P was up 1%, a little over 1%. The NASDAQ, which is tech heavy, they were up 1.4 or 1.5%, something like that. And so Wall Street was kind of rejoicing. If you're an investor and you've looked over your investments over the last couple of days, man, everything is in the green, right? Everything is looking up, right? So, I mean, as investors, you're happy, right? Now, I always tell investors, get happy on the downstroke too, right? Get happy when things are in the red because then you're buying things cheap. Don't just be happy when everything's in the green, right? But there was a surge in stocks yesterday, right? I think the Dow Jones is up 12% for the year. S&P is up, I think, 21% for the year, something like that. NASDAQ, which is tech heavy, right? They're up 30, 40% for the year, right? So the Fed is still talking about, guys, increasing the Fed funds rate. I'm sorry, let me say it differently. Decreasing the Fed funds rate by maybe 75 basis points or 100 basis points next year. 75 basis points is 0.75%. 100 basis points is 1%. So they're talking about still some cuts, right? And what happens when the Fed funds raises interest rates? It deters you from spending. But what happens when they cut the interest rates? It pushes you out there and incentivizes you to go spend because money is cheaper. So they're talking about making money cheaper in the year coming up. Perhaps with at least a few rate cuts, 3, 4, 5, maybe 2, we'll see, right? Now, why is the Federal Reserve deciding or talking about cutting rates and the core PCE is still at 4%? The core PCE is not down to the 2% target rate that the Fed has talked about every single meeting for the last, year and a half, right? And so the Fed is sort of predicting that interest rates are going to be a little bit lower this time next year. Why, if inflation's not down to 2%? The Fed, in their meeting, and the meeting notes will come out what they talked about, but they pretty much, it's been reported that they don't think that the inflation is going to come down to 2% naturally until about late 2025, maybe even 2026, right? So they want to say, let's slow down cutting rates and let's see. I think this is why they stopped cutting rates. Let's see if the lag effect of what we've been doing by raising rates so fast, so quick, let's let some of that lag effect happen. Let's not be too hasty to keep our foot on the pedal. Let's take off the pedal and let's coast downhill for a minute because what we've done so far has been working. Inflation is going down year over year. So that's kind of, I think, what the Fed is thinking. It takes time. That's the lag rate. It takes time for these things to actually for policy to work its way actually to the actual economy and the way we spend our money, right? They don't want to keep rates too high for too long because it might push the economy into a recession, right? That's the whole point. I think Jerome Powell mentioned that in what he talked about yesterday, right? So what does this mean for us, right? If the Fed decides, we're going to go ahead and cut the rates, right? If they decide that, it could have an effect on us as consumers, right? The biggest effect is obviously borrowing money is going to be cheaper, right? If you're looking to maybe say buy a home this time next year, mortgage rates that are, I think, in the late sixes right now for 30-year fix, a little bit lower than 7%, but 30-year fixed mortgages could be down at 4.5%, right? If the Fed decides to cut rates and it has a trickle-down effect on the 10-year Treasury, and that 10-year Treasury has an effect on mortgage rates could be at 4.5%. Hey, that's good. That means what's going to happen when mortgage rates get down to 4%? Well, people are going to start looking to actually go out and buy homes, right? Get mortgages and things like that, stimulating the economy because money is cheaper to buy, right? So, and then all what can happen also for us is all those short-term loans would go down. Auto loans would go down. Interest rate would go down. What we spend on our credit cards, those interest rates would go down, et cetera. So rate hikes, I do want to say this too, guys, because we forget about this. These rate hikes and rate cuts, they don't just affect individual families and individual households, right? These rate cuts and these rate hikes, they affect businesses as well. We kind of sort of forget about the fact that businesses have to borrow money. A lot of them, they have to borrow money. That's part of their business model, borrowing money, right? All the, millions of businesses that we have in America, tens of thousands, hundreds of thousands of businesses, they want to borrow money, most of them. And so if money is cheaper to borrow, it kind of stimulates businesses a little bit as well when money is cheaper to borrow. When money is more expensive to borrow as a business, you don't want to be borrowing, at 9 and 10%. You'd rather borrow at 4%. So it really affects the way businesses go about doing business, as well as us individual families and so forth. And if you have a small business, you understand what I'm talking about. So some of the more immediate effects, guys, obviously short-term loans, as we talked about, credit card loans. And don't forget, guys, smash the like button. Smash the like button. If you're in here, hit it for me, guys. It pushes this video out to more and more people and lets the algorithm of YouTube say, hey, this is an important video. People are liking this video. People are staying on the video longer, right? Also, if you're not a subscriber, you're checking this out for the first time, please peruse, is that the right word? Peruse through the catalog of videos that I have on this channel. And also feel free to become a subscriber to the channel. Very important, guys. All right. Like I said, big day today. Today is the day that we went over 100,000 subscribers on this channel. And so I'm thrilled about it. And I know that the work really starts right now. Although I put in a whole bunch of work, we're going to start the work right now and get going and really do what we can to bring you guys new information, better information, and really try to serve you guys as much as we can on this channel. But again, please tune in Saturday. We got free giveaways on Saturday, and we're going to talk about how to start this side hustle called a YouTube channel. And hopefully that'll help some of you guys out as well, because we want to, let you know about the side hustles that are out there and that are for you. And you can do this from your home with no special equipment but your phone that you have in your hand every day. You can start a YouTube channel. Again, check out Mint Mobile in the description box as well, guys. There's a link to those guys. Mint Mobile, great place to be. Great way to save money on your premium wireless services, by the way. So with that said, let me jump back over here to the chat, guys, and see what you're talking about. I got other things we can talk about. S&P, the new bill that just was put out by the House. I think it was a House that would maybe ban hedge funds from owning single-family homes. Not sure if you guys heard about that. It was introduced in the Senate, I believe. And because Wall Street investors have been buying up single family homes, but it would make home ownership by some of those big players out there be banned, right? And it would force institutional investors and owners of single family homes to sell off within 10 years. And that's an interesting thing that's happening right now. I mean, I want to keep that in the back of your mind and see what's happening with that bill. The other thing was GDP. GDP, guys, I think was reported in its second round. GDP is always reported in 3 rounds. And so quarter 3 ended in September. Yeah, September 30th ended quarter 3 because GDP is always measured in quarters. Quarter 1, 2, 3, 4. The third quarter GDP that ended September 30th, there was a report. It's been 2 reports out. The final report, I'm not sure the final report is out or not, but GDP, 5.2% growth. That's huge. That's big growth. That means the economy, remember earlier my graphic, they want the economy to keep growing and growing and growing. 5.4% is like, boom, that's a big growth spurt, right? So the economy is growing. That means, remember all the talk of the recession that we were supposed to have this time of the year about a year ago? Man, we're going to go in a deep recession. Warning, beware, right? All those people on the internet scaring you about what's going to happen. The economy is going to collapse, right? Didn't happen. Everybody was wrong, real wrong, right? Economy is still fairly strong on paper. The unemployment rate is still low, and inflation is going down. And so all those scared, a lot of times people use scare tactics, right, to make you tune in, right, to watch their YouTube video, what have you. But there's been some really robust growth in the economy, right? Third quarter of last year, economy growing big time, according to the second estimate, right? I think the third estimate's coming out in December. There's always, each month, here's how it works, guys. You get the third quarter because you got January through March. January, February, March is first quarter. April, May, June is second quarter. July, August, September is third quarter. So September 30th, third quarter. In October, I think it's October or early November, you get the first reading from third quarter. In November, late November, you get the second reading from third quarter because they have to analyze and redo the numbers and make adjustments, right? So by December, you're going to get the final numbers of the third quarter GDP. And I'm not sure if 5.2% is our second reading or a third reading, but then fourth quarter ends December 31st. You'll get the first reading of the GDP measurement in January, second reading in February, third reading in March of the fourth quarter GDP numbers. So that's kind of how that works. But the other thing, you got the president out there forgiving more student loans. You got mortgage demand is starting to come up as these interest rates fall, keeping in mind that right now, end of the year is always a great time to buy if you're looking to buy a piece of property or buy a home. At the end of the year, because it's November, it's December, the holidays here in America, most people are not out looking to buy a house. And so it's always a great time to buy a house. Usually sellers are much more willing to negotiate selling a property in November, December than they are at, say, in the summer, right? Because everybody's looking for a house in the summer and the weather's nice and all that good stuff. So something to think about. So there's a lot of stuff going on in our economy, right? Not to mention what happened over in China, by the way, right? Moody's just cut China's credit outlook. Not their credit rating, but their credit outlook. I talked about the credit ratings in a couple of other videos you might check out as well. I think they're going to be linked in the description box below. So there's a lot going on with our economy and other economies to pay attention to. But I like to give you guys an update because sometimes it takes more of a long form video, like a live, to have this update in real time, as opposed to doing a quick video that it would be an 8 or 9 minute video, but it'd just throw you a bunch of stuff. I'd rather have conversations like this sometimes. So let's see here. Prices. See if you guys got any questions in the comment section that we can kind of wrap about. Hey, thanks. I appreciate that. Let's see. Can't create hyperinflation. No, don't want to do that. Excited about rate cuts, somebody said. Let's see here. Does the lowering of rates have anything to do with the billions being sent perhaps over to the Ukraine war and to what's happening over in Israel. Um, I don't think directly, no, but there could be. There could be. I think there was a bill that was passed today. I didn't read too much into it right now, but a bill, I think the largest bill, and there's going to include some funding in there for Ukraine or what have you. So always keep up with that as well. I'm looking forward to rate cuts too. Let's see here. Boom, boom, boom. Yeah. Say a full court. Yeah, full court at 53 years old is tough. That's a tough feat. That's hard to do. But, it's fun. I needed the cardio, that's for sure. Let's see. The Fed was created on Jekyll Island. Absolutely. So, hey, good reading is how did the Fed begin and why did they begin? There was a big crash and scare back in, I think, 1907. And the Fed was, I say commissioned. That's the wrong word. But the Federal Reserve is not federal, by the way, just to clear that up, right? It's called the Federal Reserve, but it's not federal. It's not a federal government agency. Okay. Let's see. You brave. Yeah. Yeah, guys, do me a favor. Thank you for bringing that up. Please make sure you smash the like button. Miss V, thank you so much for that super chat. I appreciate it. Thank you so much, Miss V. I appreciate you always being a part of these live chats and chiming in and offering your knowledge. I certainly do appreciate that. Make sure you're there on Saturday because I'd like to get you in the winners column to grab yourself a little bit of a gift from me to you for the holidays and for the celebration. So thanks again, Miss V. Let's see, brave. Markets went crazy. Yeah, the markets went way up. I think, like I said, S&P up 21%. Man, you talk about stuff growing and growing and growing. And listen, I know, guys, when you got $20,000 in there and you grow from $20,000 on January 1 of this year to $31,000 at the end of this year, you're saying, man, that's not much. But when you have $400,000 and it goes to $500,000, you have $700,000 and it goes to $850,000, $900,000. That's a big swing. The more money you have, the bigger you see that swing. Has the stock market rebounded from the lows of 2022? I'm not sure. That's a good question. Anybody know the answer to that question? Has the stock market totally rebounded from the lows of 2022? Yeah, there is some lagging effect going on right now, guys. Lagging effect is taking place. Yeah, Dow Jones, highest Dow Jones in history, right, over the last couple of days here, or yesterday, I believe. So, that's why you want to be in the market, guys. You don't want to be in the stock market, out of the stock market, pulling in, pulling out. No, just stay in the market. Dollar cost average. Put the same amount in every single time, because if you're constantly putting money in the market, you get the full effect of these incredible increases that we find, right? You get to enjoy all of it. And when it's low, you get to buy things at a discount because you're steady putting in, right? Don't time the market. That's my opinion. Now, I'm not talking to $20 million investors, right? I'm talking to average people like me and like you guys, most of you guys in this chat, average investors, dollar cost average. If you got $20 or $30 million sitting around, $10 million in the market, your strategy could be a little different. I get it, right? Let's see. Somebody said refied a home, I think 2 years ago, from a 30-year 3.25 to a 2.515. Whoo! Sweet mother bear. Very good job. Fantastic. Congratulations to you. That was a really, really, really smart move. Went from a 30-year 3.25% mortgage to a 15-year 2.5% mortgage. Man, you can't beat that. I don't think you're going to be able to do that for the next 20 years, to be honest with you. Thank you so much, Miss V, again, on the congratulations. Thank you for understanding me. Yeah, that's what I try to do, guys, is try to make this thing a little more palatable, a little more ingestible. Is that the right word? I'm using these big words, right? We can understand it a little bit better. Let's put it like that, right? These tough economic terms and these interesting economic things that they bring to us every day. So thank you, Mommy Trader, on the 100,000 subscribers. I appreciate that. You'll be there one day. Other side hustles other than YouTube. I don't have a gift to gab. Hey, there's all different types of ways to, and I have some really solid videos on some other ways that I do make income. One way that I always like to tell people is digital products, right? It could be anything. It could be a small 10-page ebook. You could create coloring books. I mean, you could do anything that you can send online, you can make out of a digital product, and you can sell that digital product, right? If you go to smartmoneybro.com and you click on the shop tab, you'll see a few of my digital products that are available right now. There's some more coming as well. But that's what a digital product is. Anything you can download. You can sit right at your home on your home computer while you chill and drink your coffee and drink your tea and watch TV, and you can start creating on Microsoft Publisher, on Canva. You can start creating digital products, things that you know, have expertise in, have a certain amount of knowledge about, but you know other people are interested in it. It could be something as simple as my favorite apple pie that everybody loves. I could just put it together in some ingredients and create an online presence and begin to sell that recipe, or sell the recipe with instructions. Now you might say, well, hey, there's people that can go out there and find that for free. Yeah, but they can't find your apple pie for free. But a digital product might be a small book. It could be anything. It could be audio, could be anything you can put in a PDF and email to somebody. That's a digital product. Sell it. Why not? That's a really low impact way of making money. Now, in order to market and advertise your digital product, you need to actually be able to have an online presence, right? You need to perhaps maybe become an expert in an area, right? When I say an expert in an area, I mean, whatever that area may be. Maybe you're a mechanic, right? And you want to teach people how to change their own brakes, or how to check the fluids in their car, right? Lift the hood, pop the hood, lift the hood, have your towel in hand, be careful that the fan is not running on the inside of the car, go in there and pull a dipstick, wipe it off. Whatever it could be, Doc, whatever your expertise is, teach other people, show other people how to do it. Create a digital product explaining it. And then you have to market it, right? One of the things I did, I'll give you a couple tips. I have a Facebook group, private Facebook group with 1,600, 1,700 people in it. And feel free to join it. I think it's linked below in the description box. But I go in there, I talk about things, and this broadcast is actually broadcasting also in the Facebook group at the same time right now. But I mention things, talk about things, create things, and go off script a little bit, but I talk about money in that group with that group of people. Also on IG. If you go over to LinkedIn, you go over to all these different places, I'm Smart Money Bro everywhere I go. And so what happens is I've become sort of the expert on how to grow money, how to manage money, but it's taken a while, right? I didn't just do this overnight. I started Smart Money Bro in 2017, 3 years before I even had a YouTube channel, 4 years before I had a YouTube channel. So you have to sort of create a marketplace around what you're selling in terms of a digital product, right? But it's part of the plan that you can create and do. It just helps to do that, all right? That's just one example of a side hustle that you could do. Kim, thanks for asking that. Any thoughts on BlackRock Bitcoin ETF? I'm not a Bitcoin guy at this point, guys. I don't own very much Bitcoin. Because of the fact that it's not regulated, I'm still a little skeptical. I'm not totally sold on it. So I don't really push Bitcoin too much. So I would probably not be investing in the BlackRock Bitcoin ETF, even though BlackRock is a huge name in the game, right? To put their money behind Bitcoin, it means that they're sold on something for sure. Let's see here. Notice gas at decent. Yes, gas has come down, right? Gas has come down. Again, gas is energy. And energy is what we see that's in the CPI, headline inflation. And so energy coming down like that means that it's going to make CPI inflation come down, right? Because gas and energy is a large part of the CPI readings, right? CPI, or inflation, is measured by a basket of goods that go into a basket, right? And part of that is energy and food. And when you put energy and food in that basket, they kind of take up a lot of weight. And so when you see it coming down, you also see CPI coming down as well, right? Let's see here. Let's see. Yeah. I got a little cold, been a little bit under the weather, but I'm still breathing and I'm still blanking. So I'm blessed for that. Let's see here. Some growth in the economy, gas going down, mortgage applications up slightly. Absolutely. So we see some things sort of turning around a little bit in the overall economy. Let's see here. You're welcome to be on live. Excellent. Glad to have you here. Make sure you're here. Good. Be on that live on Saturday. If you're in this group right now, in this chat, please come around on Saturday, 11 o'clock a.m. I want to give away $500 worth of Amazon. I didn't want to just choose one person. I would rather give $20 to 20 people. Is that right? $20 to 30 people as a gift, as a gift from me to you. I'm going to ask some questions. We'll kind of do it like a little quiz, right? I'm going to ask some questions. Check the chat. If you answer quickly, and we'll only be doing that on YouTube for the most part. We're not going to be doing that on all the different social media platforms like we're streaming right now. We're only going to be doing that on YouTube only. So you want to come into the YouTube channel to actually check that out and become a part of it. Hey, who wouldn't want to win $20, right? You got about a few weeks before Christmas. Let's win $20 and you can go buy yourself a book on Amazon or whatever you got to do, right? Guys, make sure you smash the like button. I certainly appreciate it, guys. Please hit that like button. Not a big fan of NFTs, Pito. Man, NFTs have lost some serious value. Let's see. Florida checking in. Good to have you here. Let's see here. Boom, boom, boom. Yes, absolutely. So, yeah, I appreciate it, John. Thank you so much. I appreciate the congratulations for the 100,000 subscribers, believe it or not. Wow. So I got a lot of things I want to share with you guys on Saturday. But I wanted to talk about the Fed's move here, right? Because the Fed has they've sort of shifted, right, their outlook. They sort of shifted how the Fed has decided to go ahead and approach this thing called the Fed funds rate, right? They sort of shifted their policy, and they didn't come out and say it. And I noticed something, guys, by the way. If you ever watch Jerome Powell give his press conference after the Fed has its meeting, the Federal Open Market Committee has their meeting, and they decide whether they're going to raise or lower the interest rates. Whenever you watch him give this presentation, I need you to understand that it is scripted. It is scripted, right? It's not something that he is somehow coming up. He has to answer questions, right? But a big part of what the Fed does is the Fed has to, because the Fed knows that everybody is hanging on the words they say. So the words that they say out of their mouth, out of the Fed funds, the chair's mouth, Jerome Powell, and any of the other chairs when they're speaking in public, they have to say things a certain way, and they have to say certain things. And so it's very, very scripted. A lot of what the Fed chair says when he gives his press conference is the same things that he said before. And if they change something than what they said before, there's a very, very clear reason. And a lot of times the reason is to affect the market or affect spending or affect behaviors with money or affect perceptions with money. He never says anything haphazardly. He never comes off script. And that's because they know that the power they have in terms of communicating their message to the public is huge. It's paramount. It's very, very big. So the Fed knows this, and they understand that the way that they speak, what they say, what they don't say, what they avoid saying, what they add in, they are looking at the scripts of what he said, and they're going over the scripts of what he said. They're going over the scripts before he goes out to speak, and they go back over the scripts after he goes out to speak, and they make sure that what hits the public is scripted, and it's said a certain way. It doesn't have this word. They look at it word for word, right? So we have to understand that when we're watching the Fed give their speech about the possible interest rate cuts next year that he mentioned. He mentioned that for a reason. They don't just mention those things haphazardly, right? So there's been a huge sort of pivot in their hawkish stance on lowering the federal funds rate, continuing to raise interest rates. This is what they were saying back in June, July, August, right? Continuing to put the pressure on, very hawkish, Now, if you listen to what he said yesterday, it's very dovish. Hawkish meaning heavy, keep going, push. Dovish meaning pull back a little bit, softer stance, a little bit softer language, right? That's what we heard yesterday, and that's one of the reasons the markets responded so favorably. And the Fed understands and knows this. They understand that the markets are going to respond to not only what they say, but how they say it, how many times they say it, what emphasis they use to say it. A lot of that is scripted. And we got to know that, guys, when we're watching that. The most important thing about the Fed is that the Fed is not only controlling the money supply, controlling their balance sheet, putting money out into the economy, taking money out from the economy. They're doing all these things, but they're also a communications company. They're also a communications arm, right? That's a big piece of what they do is their communications. That's huge, right? That's very important because they know that that's going to sway things one way or the other. One way or the other, right? So we have to, as consumers, we have to understand that, right? We got to understand that what they're saying is scripted. He's going to say it a certain way. He may have to repeat it several times throughout his canned speech. And then when he answers questions, he's going to answer those questions accordingly in line with what he said in his canned delivery, right? Understand that, guys. Olathe, checking in the house. Good to have you, Steven. Fantastic, man. Olathe, I'm always there. Let's see here. Wells Fargo just told me they owe me $3,200 for enrolling in something I didn't sign up for. You better give them a call, see what that is. Pete O. Powell reads a script for sure. Absolutely. I think the questions may be scripted as well, but he's definitely on a script because it's propaganda, right? The Federal Reserve is a company, right? And it's propaganda. It has to be propaganda. Because how we spend money and how the markets respond, how investors respond, is on his words, right? So think about that, guys. Very important. Very, very important. So some of this stuff they talk about is not very complex or complicated. It's just sometimes it's terminology, what they use, how they say it, and the fact that sometimes you just don't have somebody that's willing to break this down to you when you get a 10-minute video on YouTube. And it just goes through exactly what was just said from, Jerome Powell. And it just says, and it doesn't really kind of take some time to explain it. So that's what I want to do on this channel, guys. We talk about making money, investing money, and managing your money better, and making sure we understand how what's happening with the money in the U.S. economy is affecting us, right? In terms of the average everyday consumer, the average everyday American citizen, and the average everyday investor. That's not an institutional investor, just an individual. So I just want to drop this on you guys. I'm going to get out of here for now. I appreciate you guys more than you know. I appreciate you guys for stepping in. Please check the description box below. 24 Laws of Money, my contact information, some more great videos to check out where I go into further detail about the U.S. economy. All those things are down there. Mint Mobile, right? A link to Mint Mobile, who I kind of partnered with on this video, is in the description box as well. But guys, be sure to check in on Saturday. Saturday is going to be a big day for us to have some fun, do some giveaways, answer some questions, win some money, and also learn a little bit about this YouTube thing as we celebrate 100,000 subscribers. I appreciate you guys being here. Again, smash the like button, share the link, and please, please feel free to subscribe if you're not already a subscriber. I'm checking out, but if you got questions, leave it in the comment because I always answer my comments, guys. All right? I always say at the end of every video, the best person who's going to take care of the old you is the young you. Take care of yourself. Take care of other people. Until the next video, peace.